Hi everyone and welcome back to another video. Today we're going to be taking a look at ESPX, the Evolve S&P 500 Enhanced Yield Fund, and basically doing an overview of the fund, taking a look at both fees and performance, and as well as just seeing exactly what it is and comparing it to the competition on the Canadian landscape. So let's get right into it. As the site says, so on the fund manager website, Evolve ETFs, ESPX is designed to provide investors with the performance of the S&P 500 index with enhanced yield through an active covered call strategy on the underlying securities. Um, so what does active mean? So that basically means that the fund manager can use cover calls when it's appropriate in the market conditions. So, after like the 2020 crash or the 2022 crash, when you have that recovery that happens right afterwards, they're going to be writing less covered calls on it because the market is generally going up more. So covered calls really do well in range-bound markets that are moving sideways or down. So basically, you want to limit the upside that you're giving up during those bull market scenarios. As well, this fund invests primarily in the equity constituents, the S&P 500 index, while writing covered call options on up to 33% of the portfolio. So the fund manager can only write up to 33% at the very maximum. So pretty much during like a bull market, you'd see that that number would probably be a lot lower with that active strategy. And during times where it's range bound sideways market or a downward market, probably going to be writing a little bit higher and closer to that 33%. And the cover call options have the potential to provide extra income and hedge long stock positions. So so the yield on this is because it's using a cover call strategy is a lot higher than the S&P 500 index itself. With the S&P 500 index itself right now, I think it's between one you'll get between 1 and 1.5%. But with that covered call strategy, you're able to produce monthly income off of the options that you write on the underlying index, and that brings the annualized distribution yield up to 7.77%. When I started first investing in this fund, it was a bit higher, but the share price has gone up quite a bit, and because of that, the yield goes down as the share price goes up. So actually, I think Evolve probably has some room to probably increase the distribution pretty soon based on how much it's gone up. So I wouldn't be surprised if it went up, but yeah, I think it's a very modest 7.77%. That's very good, and but it's also very conservative. It's really nice that you get that 67% upside potential and a yield of over 7%, sometimes over 8. So looking at the key facts here, we can see 504 holdings, the S&P 500, hence 500 plus. They hold, I think, if I click here under see more details, um, so they actually hold a major S&P 500 index ETF, which is IVV. Think of this. So I own BOO in my portfolio. IVV is just a competitor. It's like the exact same thing. There's an S&P 500 index, and then they hold the individual components of the S&P 500. So yes, so that's about. Um, and I wonder. I almost think that they write call options almost on the. I think they write call options on both the individual stock holdings so they could write it on Apple, they could write it on Nvidia, Microsoft, but they can also write it on the IVV position, which is the S&P 500 index ETF inside of the fund. So yeah, and then the fund size is growing quite quickly. It's becoming a very popular fund among income investors at $164 million in assets under management. So yeah, and the style is index based, as we mentioned before, or sorry, yeah, sort of in that intro, index based with an active cover call strategy. So yes, okay. So the management fee, what I really like about ESPX is it has a very low management fee. The management fee on this one is 0.45%, which is very low compared to many cover call ETFs on the um, both the Canadian and US side. So mainly Canadian, actually. Canadian, they do charge a bit more than on the US side. I've seen like JEPI and JEPQ, for example, I think they are like zero point 0.3, but that's on the US side, so you'd have to invest in USD. So this is in Canadian dollars. mainly there are different versions of the fund, but the one that I invest in is the one that's in Canadian dollars. So very, very low. The MER is actually 0.69% as of April 26th. So a bit higher than the management fee because of all the costs of operating the fund. So yeah, so 0.69%, still very, very, very cheap for a covered call ETF. So we'll take a look at performance here. So I prepared a on Koyfin here. We can see SPX. This is just literally the S&P 500 index. So if I go under, if I go under IND or for index, you search SPX. That's what I added there. SPX S&P 500, and then ESPX, which is the fund that we're looking at here. So you can see the performance is basically neck and neck with the S&P 500, which is really good. It sort of diverged a little bit. So you see here there was a little bit of outperformance during those sideways markets. So cover call ETFs, they can outperform during times of like down markets or sideways range bound markets. So it was pretty much neck and neck for the most part. But then once we got into 2024, where there was like a really rapid increase in the S&P 500, you can see a little bit of a divergence here. Nothing to be really concerned about, in my opinion, but you get that higher yield. So you know that the trade-off of getting that higher yield is a bit of giving up a bit of upside potential. So during bull markets, you would expect a cover call ETF to underperform a regular ETF, but you get that enhanced monthly income as a bonus. You're giving up a little bit of long-term growth for the sake of yield now. So that's the advantage. So if you don't need income now, you're just investing for retirement. Better to stick with funds like VFE, VOO for your S&P 500 exposure. But if you want income now, or you're a hybrid investor like me, you like the best of both worlds. You like long-term growth. So you have a really large position in BFE, but you want some income on the side. Then I think this is a good solution because it doesn't give up too much. Out of the cover call ETFs on the Canadian market, this one is really like a modest cover call ETF. It doesn't use leverage. It's index based and it has lower fees. And it only writes cover calls on up to 33% of the portfolio, which are all really good pluses, in my opinion. So yeah, that's its performance compared to the underlying index. So that's what we want to see first. And the next thing is I'm going to look at one of the competitors. So basically, when you think of the S&P 500 on the Canadian landscape, you think of three options, basically four, because there's a leverage version of one of them. So, but there's basically four. There's ESPX, and then you have HYLD from Hamilton ETFs. And Hamilton ETFs actually uses 25% cash leverage on their fund. I used to own this fund. I switched from HYLD actually to ESPX. So it uses 25% leverage. So you're borrowing money from a loan facility in order to enhance the income, both the income and share price appreciation by 25%. So if the stock goes down 10%, you're going down 12.5%. If it goes up 10%, you're going up 12.5%. So just keep that in mind with a fund like this. But interesting with HYLD, you have a bunch of underlying ETFs inside of HYLD, and some of them are holding really tech heavy funds. So this isn't really an S&P 500 index based fund. It mimics the S&P 500, but it's not really looking at the underlying index exactly. So one thing that I'm a bit concerned with the HYLD is that you have both 25% leverage, and you also get a lot of concentrated NASDAQ 100 exposure. So some of the funds inside the NASDAQ 100 will be in this QMAX fund that makes up like almost 30% of the fund. And so if we look at the underlying of QMAX, it has really high exposure into Apple 8.3%, Tesla 7. It's only 20 funds, I believe. Um, how many? I'm pretty sure it's only okay, it's not that many though. It's not 500 funds. It's like the really top names of the Nasdaq make up like 30% of the fund, and then with SMAX, it's also extremely concentrated as well. I think it's also only like maybe this one is the one that's 20 funds actually, but yeah, like you have. I mean, some of them are more value-oriented funds like JP Morgan and Chase. Not all Nasdaq tech, but again, it's very concentrated as well at the top names of the S&P 500, not the top. So that just keep that in mind when you look at HYLD. So on top of being 25% leveraged, you also have concentrated Nasdaq and like really the top names of the S&P 500 that make up a bulk of the fund. And ESPX is outperforming it since inception. So just by a little bit, I mean, by 3%, like basically the amount that it was, I think, okay, so ESPX relative to the S&P 500 is, um, here it's about 2.24% underperforming, but HYLD is underperforming ESPX by almost or over 3 basis points, or three percentage points. It's about 3.5% actually. So yeah, just keep that in mind. This fund has a 25% leverage effect on it, and it has Nasdaq tech exposure, and it's underperforming ESPX. Now, HYLD did have a lot of changes that it underwent in the like 2023, 2024 area. So, in the short term, if we look at like year to date, for example, we've had, because it's going to have like I said, it has concentrated Nasdaq exposure and really top names to the S&P 500. It's going to probably, outperform because it doesn't have the rest of the, 480 funds or companies inside the S&P 500. And it's got 25% leverage. So year to date, it was actually starting to outperform quite a bit. But then, with that 25% leverage and that concentrated exposure during the downturns, HYLD is just getting killed. So like here it was above quite a bit, but then the performance was nearly equal after like getting kind of decimated in that that last drawdown. So just keep that in mind with HYLD. I think there's a lot of investors in HYLD that I think aren't aware of like the really like high low. Let me see the risk rating. Like they put medium risk rating, but honestly, like when you have most Nasdaq 100 funds are considered high risk, and on top of that, they're selecting like 10 funds, like 10 to 20 funds within the top 10 to 20 funds within that. So I really just kind of disagree with that risk rating, and on top of that, adding leverage. It's kind of a no-go for me. So I really think that ESPX is much better, like way lower risk, and it's outperforming HYLD. So yeah, that's the first comparison that I'm going to make. So yeah, we're done with HYLD. We're going to take a look at USCC and USCL. These are the other two competitors. So USCC is the Global X S&P 500 cover call ETF, and USCL is the leveraged version. So just like HYLD employing 25% cash leverage, USCL does the same on USCC. So it's only one underlying constituent, USCC, and it does 25% cash leverage. So with these funds, if we do a performance comparison, so we're gonna, here, let me just delete these two, and then we'll do USCL first, the leverage version, time versus ESPX, neck and neck. So 25% leverage, and these funds are neck and neck. Like it is very, very close. But this is a little bit deceiving because ESPX is I don't know if they mentioned here. Okay, sorry, yes. One detail I left out before, but I want to just come back to this. So it's hedged to Canadian dollars. So the influence of the US dollar versus the Canadian dollar um, doesn't affect ESPX. It's hedged to Canadian dollars. So if the USD appreciates relative to the Canadian dollar, it has no effect on ESPX. Same with HYLD. It's also hedged as well. So if we go down here, let me see here. Yeah, Canadian hedge as well. So it's a fair comparison, right? Because it's Canadian hedge. But there is no currency hedging with USCC. and USCL. So let me plot USCC in here as well. We can take a look at that. So USCC, and this is kind of weird. It's kind of a Koyfin bug. I don't know why. Whenever I put USCC in, it plots it good for a second, and then for some reason it shows a big. This is incorrect, obviously, but you can see these funds. So USCC, and then you have the the 25% leverage version USCL, which obviously it's going to outperform, like USCL is going to outperform USCC because that 25% leverage. So you see ESPX kind of sitting in the middle of them. However, this is unhedged and unhedged to the US dollar. So what's going to happen here is you have the US dollar is affecting this, and it's propping up the performance of USCL and USCC. So it's not really a fair comparison anyways. So what you can do though is you can compare, there are a few different versions of ESPX. You have the hedged to Canadian version, and then you also have an unhedged version, ESPX.B. So what I'd like to do here is plug ESPX.B in, and it has a lot lower volume. It's less popular than the ESPX currency, the hedged version. But so like that's why the lines are a lot more, a lot less distinguished. But it has outperformed like all of the like. So now let's take ESPX out of the currency hedge version. We can take a look at unhedged for it, and now this is a fair comparison. The unhedged version and against USCL and USCC, and now this is a fair comparison. And you can see ESPXB is really, really outperforming USCL and USCC. Here, let me just see if I can cut the date back just a little bit for USCC so I get a cleaner, there we go. I got a little bit of a cleaner graph. So yeah, just keep that in mind. Like whenever you're doing performance comparisons, just make sure you're looking at, is it currency hedged as well? There's a 25% leverage, so USCL 25% leverage, USCC unleveraged. ESPXB, this is the unhedged version, and it has no leverage, and it's beating USCL. So those lower fees and the 33%, the cap of 33%, I think are like on the covered call writing is really what contributes to that outperformance. So yeah, your yield, one thing to keep in mind is your yield's going to be, because it's only 33% of the portfolio, the yields are a lot more modest, like 7.57% for ESPXB and 7.77% for ESPX. Like HYLD with that 25% leverage, and USCL with that 25, they're double digit yields, like 13% yield and 12% yield. But don't be fooled. Take a look at the performance for yourself, and really that is how you can come to a decision rather than just looking at the yields alone. And so again, like if you're a pure income investor, all you care about is yield. You're in retirement. Maybe you would like these funds over ESPX and ESPXB. However, for me, it's just not. I I don't care about getting a few extra percentage points of yield if it comes at a drastic performance. Performance performance drop, or taking on substantially more risk, like using leverage or using more aggressive covered call strategies or concentrated Nasdaq exposure, concentrated S&P 500 exposure. It's not like, to me, it's not worth it. So yeah. So in my personal portfolio, I invest in the hedge to Canadian version. Now, and let's just do a quick performance comparison. We can do ESPXB versus ESPX. ESPX. Given that ESPX is underperforming ESPXB due to the US dollar appreciation, the strength of the US dollar versus the Canadian dollar in more recent times, you might want to, the question might be, well, why aren't you investing ESPXB then? And the reason is because I already invest a ton in VFE and VOO. So I have a lot of unhedged exposure already to the S&P 500 with VFE and VOO. So VFE is unhedged. So it's no currency hedging employed on it. So I was like, okay, I like for my secondary income generating version of the S&P 500, I don't mind just taking the currency hedge version. And also you have the benefit of added liquidity. So ESPXB isn't as popular. So, there's less liquidity, less trading. So there's less like data points on it. So that's why I kind of just decided to go with ESPXB, even though the performance of ESPXB, or sorry, ESPX, that's why I decided to go with ESPX instead of ESPXB, even though the performance is slightly better for ESPXB. So yeah, so I hope you enjoyed the video and learned about one of my my top income positions, ESPX. And I'll see you guys in the next one. Thank you.